Welcome to Simply Money. We're going to look at what are index funds, what are market indexes, and explaining those in a little more detail. And then we're going to look at some examples of index funds. And at the end, bonus, I'm going to give you my two favorite indexes overall. Stay tuned. What are index funds? Simply put, index funds are passive income made up of a group of stocks that track a market index. We're going to look at what are those market indexes and how do they work. An index is a group of stocks that represent a segment of the market. We're going to look at what those different segments are and how you can decide which is best for you. These indexes serve as a benchmark of these various sectors or markets. They follow whatever that market or sector is indexed against. So if you have 5 stocks that make up an index, whatever those 5 stocks are doing, the index is doing. Index funds comprise many stocks of various sectors with one purchase. The benefit of this is with one purchase, you're immediately getting diversification. There's variations of how much diversification each index has, and we'll look at some of those. Some are smaller, more focused on a particular market or sector. Some are much broader, as much as even the entire stock market. Now let's look at market indexes. Market indexes are constructed by taking various stocks and weighing them on how much of each of those stocks will impact that index, as well as what sectors. Is it going to be made up of a single sector or multiple sectors? We'll look at in a minute what those sectors are and how they can impact your diversification. Market indexes come in various types, such as the broad market index. For example, the S&P 500 is made up of the 500 largest cap stocks in the stock market. Large cap just simply means the largest capitalization. Those companies worth the most. So you're talking, as of the making of this video, companies such as Apple, Microsoft, Amazon. You also have the broad index as far as the entire stock market. So this index would make up the entire stock market from the largest to the smallest. So all stocks that are publicly traded would be part of this index. Now each stock would hold a different weight depending on the rules that are set up for that index. Another market index would be the sector index. These are indexes that are made up based on a particular sector. For example, technology. So this index would be made up of companies that focus on technology. Or energy. Maybe you have an index that is focused in the sector of energy, or retail, or healthcare, real estate. These are all sectors, different types of stocks that focus in that sector. So that market index would be in that sector. So when you're diversifying, you're not only looking for various stocks, you're also looking for various sectors, so you can make sure that when one sector is high, possibly it's covering for another sector that is low. So a well-diversified index fund will have a wide array of sectors. They're also known as regional or global indexes. These are indexes that are based on companies and stocks based on their geographical location. And these are international stocks, European stocks, the Asian market stock. There are various regional and global indexes that you can follow, again providing a wider diversification for your investments. Bonds are considered the safer investment and usually used to help balance and safeguard some of an individual's investment. I'm not a big proponent of bond investments. That's my opinion. I like strong dividend index funds. We'll get into my favorite in another video. Keep an eye out for that one. So each index provides the investor exposure to the various sectors, whether it's because of their interest or their knowledge, because you should not invest in anything that you do not have a good understanding. I'm not here to give you investment advice on what to invest in. I'm here to help provide you information and knowledge for you to make wise and informed decisions on how you should invest, where you should invest, and in what you should invest. Bottom line is, investments are your choice. I don't care if your financial advisor is telling you or your best friend's telling you, nobody should make the decision other than yourself. You can seek counsel, you can seek other people's advice, but bottom line, it's your money. You're the one that makes money when it does well, and you're the one that loses money when it does not. You cannot blame your financial advisor. They should be educating you, teaching you what each investment is and how they work for you to make an informed decision. Now, let's look at some examples of market indexes. The S&P 500 index, which I mentioned a moment ago, is comprised of the largest 500 stocks on the US stock exchange. Now, these stocks combined hold about 80% of the value of the entire stock market. These are your largest companies, Apple, Microsoft, etc. An example of an S&P 500 index is SWPPX. That's a Schwab index S&P 500. It follows the S&P 500 index. The reason I like the SWPPX is because of its low expense ratio of 0.02, one of the lowest that you will find in any S&P 500 index. Not only that, its 10-year performance has been 12% return, and that has been steady growth. Now you got to remember, when you're investing, whether it's in a single stock, index funds, mutual funds, there are going to be years, days, weeks that it's up, and years, days, weeks when it's down. You're not in this for a month. You're not in this for a week. This is a long-term plan. It doesn't matter if your fund is down right now. Where will it be in 5 years, 10 years? History tells us it always goes up. That's why we want to be diversified. I give examples of companies when people like to invest in individual stocks and why that's a bad idea in my opinion. Even Jeff Bezos said he saw the future of Amazon possibly going bankrupt. That's right, companies go bankrupt, even the big ones. Think of Sears. Sears was one of the most well-known companies out there. Lots of people understood Sears, stood by Sears. They're almost an American icon. In the early 2000s, their stock had peaked, and now they're going bankrupt. Their stock is worthless. If you had invested in that, you had no diversification. You rode that wave up, but you also crashed when the wave came down. Diversification is your friend when it comes to investing. Do not put all your eggs in one basket. Diversify, spread it out. Another example of a market index is VTSAX. That's Vanguard's total market index. This index is comprised of every stock on the stock market with a 0.04 expense ratio. Now, I've mentioned expense ratios twice now in this video, and if you're not sure what those are, keep an eye out. I have a video coming out shortly on all the components of index funds and what the terms are, what they mean, and what you should be looking for. As far as VTSAX, what that does is it gives you exposure to the entire market. So not only do you have the 80% of the value of the S&P 500, but you also have exposure to every other company on the stock market, even the small companies that have the potential of becoming the large companies. Think of 1990s Amazon. It was a small company. If you were in the S&P 500, you would not have had exposure to that. Being in an entire stock market index, you get exposure to those explosive companies that have worked their way up. You also have exposure to those larger companies that have fallen off, and they'll fall out of the index when they're no longer part of the stock market. With any investing, there are ups and downs. There are rainy days and sunshine days. But it's a long-term goal that we're looking to reach our financial freedom. I hope you found this video informative and look forward to some other videos I have coming out soon on index funds, what they are, how they work, some of the nuances of them, and some of my favorites will be given as bonus footage.